I'm delighted to welcome tonight's speaker, Shirley Speakman, a colleague of mine, actually going back a number of years in various jobs. Last week, you heard from some VCs about what they are looking for. Shirley is, in fact, a practicing VC, and today she's going to be talking about VC terms and conditions. And trust me, that's not terms of endearment. Shirley is the Director of Investments for the Investment Accelerator Fund. That is a small early stage fund making investments of up to $500,000. It is, you heard again last week, I think from Brian Kerdman, just how shrunken the Canadian venture capital community is. The IAF is in fact one of the most active early stage funds. I would hazard a guess to say it is the most active. And Shirley has been involved in the closing of 30 plus deals. In fact, over her career, she has worked on nearly 80 individual investments, plus the closing of 2 VC funds. So she is well placed to talk about the terms that you will likely encounter should you actually get the interest of an investor, particularly a VC. So I'm going to mention one other thing about Shirley. These discussions about closing a deal can get quite protracted as one negotiates. Should you ever come to the IAF and get involved in negotiations with Shirley, do not think that you will outlast her. She has completed 8 marathons, and she is an active triathlete, and she's currently training for her 3rd Ironman competition. She recently completed her 3rd ascent of Mount Lemmon in Arizona, which is apparently a 42-kilometer cycle up 6,000 feet of elevation at a gradient of about 10%. You start in the desert, you end up in an evergreen mountain top resort, and the best part was the 72 kilometers per hour descent from the top. So this is not a lady to mess with if you're negotiating. So on that note, Shirley, over to you.
Thank you very much, Tony. I appreciate it. Thank you very much, Tony, for that kind introduction. It sounds rather ominous, but really I'm not that bad. Tony was kind enough to ask me to come and present and talk to you about what VCs want with respect to their terms and conditions and help you begin to understand what the motivation is behind those terms and conditions and help you understand the rationale for why those terms and conditions do occur. And what I have found is whenever I'm trying to bring 2 parties together in any negotiation, I find trying to find common ground really important. So the one thing that you should know is that you do have common grounds with most VCs. You want money. Who in this room doesn't want money? Right? No, you want money. The difference between you and a VC is that you want money, they want big money. They are motivated by big returns. And every decision that they make is grounded and rooted in that reality. So you need to understand, as I said, the VC motivations. That drives it's driven by their entire model. It impacts the terms and conditions that you're offered. And the one thing I want you to understand tonight is that most companies are not VC-able. Let me just repeat that. Most companies are not VC-able. And it's not because your company isn't a fantastic opportunity. It's not because you don't have a business that will be successful. It's because the business that you have doesn't provide the big money returns that the VC is looking for. So, but if you decide, after what you hear tonight, that you do have a big money return, and you're willing to accept the terms and conditions that a VC is going to be offering you, then you're going to be better equipped for the information that I give you tonight. So let's talk about some of that. In my business, it's all about kissing frogs. I look out into this audience and I see people and I see frogs. And I have to kiss a lot of you. to figure out which ones are going to be my prints. Because the way that my model works is that I have to kiss about 1,000 companies. 1,000 companies before I find the 10 that I think have the potential to be those big company wins, those big money return companies. In reality, after I make that selection of 10 companies, 2, but most likely 1, is going to be the one that makes my portfolio, that returns enough money that all the other companies that I've invested in, it's okay. I've made my return. So 1 company has to make up the return for the entire fund. The other 6, on average, are going to be in what we call the land of the living dead. They're just not going to be spectacular wins, but they're not going to be so bad that you want to pull them off life support. They're just going to chug along. The other 2 are going to be phantasmagorical in their failure. They're going to burn out pretty quickly and pretty badly. So my winners have to offset my losers. When we're looking at startup companies, we're actually looking to achieve a 10 to 12 times return in 5 to 7 years. So big money returns in a relatively moderate time frame. For an existing company, we're looking at a 5 to 7 times return in 4 to 5 years because you're more advanced. So what does that mean for you? That means that a company that doubles, think about that, a company that doubles in revenue every year isn't good enough. That every opportunity that I look at has to have the potential to be that big company, that big money return. So let's take an example. There's a company that I'm sure you're all familiar with called YouTube. YouTube's early investor was a firm, a granddaddy out of the venture capital industry in Silicon Valley called Sequoia. Some of the deal stats. So YouTube sold to Google in 2006 for $1.65 billion. I love that word, billion. It's a big number. Sequoia, at that point, owned about 30% of the company, had invested $11.5 million, and for their investment received a $495 million return. Not bad. It's pretty good. 43 times the money that they put in. That's a big money return. On any measure, that's a great deal. But you know what? That was the big win out of their portfolio. That was the company that made that portfolio for them. Everything else that they had invested in, land of the living dead or the spectacular failure. Still an awesome return. It was a good fund, and it was a good return for that fund. But that's the reality for most VCs. So let's set some reasonable expectations for you. So you're going to go out and you're going to try to raise some money. Now you have the basis of understanding of the motivation behind most VCs. It's going to take you between 6 and 9 months to raise the money that you're looking for. And you're going to go through several meetings with your VCs. And that's not because they can't write you the check. That's because they don't know who the heck you are. And they're not going to put money into somebody that they don't know who you are. So they're going to want to spend that time getting to know you, measuring your say-do factor. That, frankly, is a Shirley euphemism. And that means you say you're going to do something. Over the course of that 6 to 9 months, I want to see that you actually do it. So you want that ratio to be really pretty high. And they also want to make sure that they have some time to assess how well your projections and your assumptions are. Are they at least close to the truth? So, and all of that helps build confidence. And that's what a VC needs. So what are some recommendations that I have for you as a result of understanding their motivations and what you can expect from a VC? You should spend as much time getting to know your VC as they're spending getting to know you. You want to know things like what their process is. Because I got to tell you, if you're spending your time talking to an analyst, you're not talking to the right person. Investment decisions are made at a higher level. You want to know how their process works, and you want to know when their investment decisions are made. These are all really important, and they're all reasonable things to try to find out through this investigative phase. You want to know where they are in their fund life cycle. So every fund is about 10 years in length. They go through various phases. They have an investment phase, they have a management phase, and they have an exit phase. If you are a startup company because of that, 5 to 7 year time horizon that they have for an investment for a startup, you don't go and talk to a VC that's looking down the barrel of a 7-year life at this point, because you won't fit their criteria and their need for where they are in their fund. Ask them what their last deal was, because you know what? That tells you a lot about what their appetite is. They all publish the portfolio companies that they have invested in. Pick up the phone and talk to the CEOs of those portfolio companies. Find out what they're like as investors. How do they deal with good times and bad times? Because you want to know how they deal with the bad times and when you don't meet your targets and your expectations, because some of the terms and conditions that we're going to get into later are going to be really impacted by how they react during those tough times. How much cash do they have available to invest? And how much do they set aside for each investment on average? Again, it's something that will come up as we talk later in terms of terms and conditions. And the other piece of advice I want to leave you with is that when a VC doesn't tell you yes, they're kind of telling you no. Right? So at the end of the day, you need to be able to live with this VC. If you're good enough to get a term sheet and you're good enough to drive towards a close and get the final documents executed, you have to live with these guys until exit do you part. So you want to make sure you've done your homework on them during that 6 to 9 months that it's going to take you to get the cash anyway, to make sure you're going to be able to do business with them long term. So let's get to the nitty-gritty. What is a term sheet? Let's be clear. A term sheet is simply a non-binding offer to invest. Just because they've given you a term sheet doesn't mean that you're going to get a check at the end of the day. Because a lot can happen between when you get the term sheet and the final documents being executed. And I have to tell you that every sophisticated investor that I know uses term sheets, because it is the foundation on which everything else occurs. And it's a basis to have negotiations and discussions. So what are some of the basic terms? Well, frankly, there are 4 terms in my more than decade of doing this that I have discovered don't create heartache for anyone. And that's 1, your company name. That'll appear on the term sheet. 2, the investor's name. That'll also appear on the term sheet. 3, how much they're willing to invest. And 4, the date of the term sheet. Pretty much every other term and condition that you see from this point on is going to give somebody heartache. But what you need to keep in mind is that everything from this point on is about managing the VC's downside risk. What happens in those bad times? So that's why it's important to make sure you know who they are and how do they react during those bad times, so that you have a good way of assessing how they are going to manage their investment. So what's the first point that causes people pain? It's valuation. Your company is worth X. And let me tell you something, valuation isn't art. It is not a science. It comes down to what you're willing to accept and what the VC is willing to accept. Because frankly, you think your company's worth a certain amount, and I can guarantee you that the VC thinks it's worth a heck of a lot less. So you can do all the discounted cash flow modeling you want, but you don't have cash flows to discount. You can do all the multiple of revenues that you want, but your revenues haven't materialized. And you can also talk about, multiples and comparables to other transactions. But you know what? Those aren't your company. So really it comes down to what can you live with at this point in the negotiation. Now, just as a sidebar, a little plug for the IAF, we believe that valuation is really a mug's game. Kind of do one of these. So we put off that entire valuation discussion until a later point. But we still want to make the investment. So we say, we'll invest in you, but we're going to use an investment instrument called a convertible debenture, which says, I will loan you the money, and at a future point in time that we define with you in negotiations, we'll convert it. But in exchange for having made the investment today, we want a discount to whatever the future round of financing is done at. So if you go out in the future and you raise money at $1 per share, well, because I went in early, I want a discount to that. I want those shares at 80 cents a share. instead of $1 a share. And that's to compensate me for the early risk. I also want to charge an interest rate because there's time value to money. So that's us, and that's the IAF, and there are some other VC firms that do that as well. But if you don't use that instrument, and a VC is trying to figure out what your valuation is, they start with the numbers that you've given them. They start there. And they start there because if everything goes to plan, you're probably right. Your company could be worth what you say it is. But I gotta tell you, I have never, ever seen a company execute 100% to plan. So that means that the VC will do something called rationalizing your forecast, which basically means they figure it's going to take twice as long and twice as much money to get to where you think you're going to be. And alongside of that, they then develop a long-term financing strategy, which says, we're going to put $1 million in now, and then about 18 months we'll do a Series A, and that'll be for $5 million, and then we'll have to do a Series B as you expand throughout North America, and then a Series C as you go global. And what we hope is that as we make these additional investments, you're adding value. But what you see, if you follow the green line, that's you creating value. So from the VC's mindset, they've overpaid at that early stage in the hopes that they've reserved enough money that in the later stage, they can still play along and pay less than what they should be. So that's why it's important to understand how much they set aside, their reserves is what it's called. So, assuming that you can get past the valuation issue, the next issue that you have to deal with is the type of security that they're going to want. So how are they going to invest in your company? I'm assuming that most of you have created a company or plan to create a company, and the vast majority of you will use an instrument, probably a common share. You know, everybody's got common shares in my company. Well, everybody but the VC. The VC does not take preferred shares. Basically, they're saying, you started the company, you're bearing the risk. If this goes south, then I want to get paid out first. And a preferred share ranks ahead of a common share in liquidation. These are the terms that we talk about when we say we're trying to minimize our downside risk. So the security that we're taking, preferred share over a common share, helps to minimize our downside risk in bad times. Another reason to make sure you understand how a VC reacts when things don't go according to plan. So, after you get past the valuation and you get past the security that the VC wants to take, what's next? Well, I can guarantee you that the VC is not going to invest in a shell company. They will want to make sure that the intellectual property is assigned to the company. It's all been rolled in. So the inventor assigns their intellectual property to the company. Any employees have IP assignment clauses in their contracts. If you've hired consultants to do any of the work, they want to make sure that the consultant has assigned their intellectual property. If the intellectual property is rolling out of a university, they're going to want to make sure that any licensing agreement is clear and that even there is an IP assignment clause within that licensing agreement. So my suggestion to you is to avoid all convoluted IP structures because frankly, they're going to be unwound. So there's a number of entrepreneurs who say, well, I'll put my IP into a separate company that's owned by my wife or my spouse, and I'll license it back on an exclusive basis. And no, that's not going to work. That is not going to work. The first thing that we'll do is we'll say, intellectual property is assigned to the company. And it makes sense. We're putting money into the company. We want to make sure that the real asset is there. Next are key employee agreements. And the key terms in a key employee agreement is the non-compete. So what we basically say is that we can't invest in a company and then have you as a founder decide to leave and go start a competing company. And then further we say you can't solicit. So there's non-solicitation, and that's not about somebody on the street asking for it. It's actually about you can't start a company, leave this company, start another company, and then go try to steal the customers or employees of our existing company. And this is typically where that IP assignment clause is contained, is in these key employee agreements. Next, of course, is an ESOP. And VC will look for an ESOP. And the philosophy is that you want to put everybody in the company in the same boat, motivated by the same factors, all rowing in the same direction. And an ESOP can do that. It also can be used to attract talent. So an employee share ownership plans gives your employees a piece of the company. It gives them skin in the game. It should be between 15 and 20%. I've seen them as low as 12. But it should be large enough to accommodate a new CEO if one needs to be brought in, any new executives, VP marketing, VP product management, whatever it happens to be, and board members, because board members will also need to be compensated. The key thing, there's a little tweak here that I want to draw your attention to. Some of my VC friends might not like this, but it's my belief that a VC should not be compensated through an ESOP for sitting on a board. Frankly, in my opinion, that's our job. That's how we monitor our investment. That's what we get paid to do. So the next thing you need to keep in mind is that you need to understand whether the VC wants you to put this ESOP into place before they put their money in or after they put their money in. Because if they want you to put the ESOP in place before they put their money in, that means that you're bearing the brunt of the dilutive effect of the ESOP. And this is just a point of negotiation. So who bears the brunt of it? And you can come to a negotiated agreement, pre, post money, something like that. But it's something to it's something to be aware of and know specifically what they're asking for. Next, beyond a preferred share ranking ahead of a common share in liquidation, they also have a feature called a dividend. And a dividend is just a certain amount, maybe 8%, between 5 and 8%, that accrues on top of the share price. And it doesn't, but the dividend does not get paid out. It just accrues until there's a conversion event, in which case it's the principal and the dividend that get converted. Next is a liquidation preference. And frankly, this is the nasty one. Liquidation preference basically says that I'm the VC and I get my money back before you do. So if there's a $10 million exit and your VC has put $5 million in, they scoop $5 million out of the company and then they say, divvy up the rest. Fairly reasonable because you know what? They put their money in, they're investors and they want their money back. They've got investors that they have to report to. They have investors that they have to give a return to. They don't always take this route. This is one of those situations in a downside. So it hasn't been that hit it out of the ballpark success where you're right, I want to convert and I want to get into common because that has more economic potential for me. This is one of those, you know, we got a good return, a medium return. But what you need to know is whether this is what's called a participating liquidation preference or whether it's just a regular liquidation preference. So a participating liquidation preference would say, here's the $10 million. I'm scooping out my $5 million because that's what I put in. And then now I'm going back into the pool and we divvy up the remaining $5 million among all of us. So I am participating in the distribution of the residual amount of money that's left over. In the heyday of the bubble, liquidation preferences hit as much as 5 times. So a VC would want to get out 5 times their original investment plus dividends before anybody else got their money out. And frankly, that was a reaction to overvaluations in the industry. So in the days when you could start up an internet company and get a $100 million valuation, that's what caused 5 times liquidation preferences or even more. But anti-dilution, again, all about minimizing the downside risk. So please keep that in mind. All of these terms are all about minimizing downside risk, and that's how they have to be interpreted. So recognizing that an entrepreneur or a company rarely executes 100% to plan, it may end up having to go raise money in a down market after perhaps it has missed its targets. And that leads to what's called a down round. So you originally issued shares to me at $1 a share. Now you have to go out to new investors and try to raise money. But because it's a bad market or you've missed your targets, they're not willing to pay $1 a share. They're only willing to pay 50 cents a share. So a VC will say to you, if it's full ratchet anti-dilution protection, you have to issue me the number of shares that gets me to an average price of 50 cents a share. Because the philosophy would be, you were managing the company, and there's a down round because management didn't perform. Okay. The alternative is a weighted average anti-dilution protection. Weighted average basically says, we raised a couple of bucks at $1 a share, and we raised some money at 50 cents a share. We're going to weight average those two, and we're going to issue the original VC investor the number of shares that is required to get it down to that weighted average price per share. So what that does is it really says we're kind of both responsible for the fact that there's a down round, or maybe conditions are outside of our control. But management didn't perform, and maybe I didn't bring the value to the table that I should have. So a weighted average is a little bit less onerous on founders than a full ratchet anti-dilution. Next is the redemption clause. Remember that 10 to 12 times in 5 to 7 years? Well, surprisingly, there's this clause called the redemption clause, which basically says the VC can come to you in 5 to 7 years and say, buy back my shares. And they do this typically when the company is kind of obviously not one of the ones that's going to make their portfolio. And what this means is that as the company, you need to either come up with the money to pay them back their money, or the VC will essentially force a sale. So again, as you're doing your due diligence on the VC, make sure you know where they are in their life cycle. Because this is one of those clauses that tie back to when they are in their life cycle. Then there's a whole slew of other privileges and rights that come when you start asking for other people's money. And these are the terms that they're really important to understand, and to understand your VC and how they react. They basically don't really matter in good times, but they do constrain you. So let's take a look at some of those things. You've now asked for other people's money. You're not in this alone anymore. And you can't make decisions independent of your VC anymore. You just can't. It's just not done. So the things that they take a look to have approval over are things like changes in the nature of the business. So if you're going to acquire or divest of a division or a product line, you got to let them know, and you got to ask them for their permission. There's changing capital structures, approval in business plans and operating plans, any change in the key employee, the creation or addition of the ESOP, any unbudgeted expenditure in excess of typically about $5,000. So step back and just take a breather, because I know this might be kind of tumultuous for many of you because you're entrepreneurs and you frankly don't like people controlling what you do. But my advice to you then is don't ask for other people's money and don't ask for VC's money. Information rights are things that they're going to want. Things like monthly prepared financial statements, which when you're managing your business is probably a good thing to have. It's a discipline that you should have within your company to know how you're doing. They might want them anywhere between 20 and 30 days of month end. They'll want quarterly financials. They'll want quarterly financials compared to budget. So actual compared to budget, and an explanation of why there's a difference, if any. They'll want board material provided in advance of the meeting. interesting concept. Material for a meeting provided in advance as opposed to as I'm walking into the meeting. The yearly operating plan, again, prepared and provided probably about 30 days before the beginning of the year. Share restrictions. Share restrictions. You have shares in your company, and you're the founder, and you can't sell your shares. Because it really sends the wrong message. I'm a founder and I want out now. No, if you want to sell your shares, talk to your VC. Make sure you get their approval to do so. There's drag-alongs. A drag-along says that if a certain number of shareholders agree to sell the company, then they can pull everybody along. Everybody else has to sell their shares as well. Tag-alongs, say you receive an offer to sell your shares. I can put up my hand as the VC and say, I want to play along on that sale. And the reason they have these share restrictions and these certain privileges, what do they have? They have investors that they have to report to. They have to give money back to their investors, and therefore they need an exit. And each of these, the drag-along and the tag-along, provide them an exit. They're going to need these. It's part of their business. The board. Probably most of you have boards. It's probably made up of friends and families and friendlies. That will change. Typical VC board has 5 members, 2 nominated by the founder, 2 nominated by the VC, and 1 independent director. What's typically up for negotiation is how that independent gets nominated and approved. So it's either the VC nominates and you get to approve, or you nominate and the VC gets to approve, or it's a combination of you both nominate people and you both come to terms with it. But at the end of the day, the VC is going to want to make sure that the person who sits on the board as the independent director is satisfactory to them. I've already mentioned that they're going to want to have material provided in advance. And there's another interesting little tweak that VCs want, and that is that board meetings aren't properly constituted unless they are present. So keep in mind, a board is one of the ways a VC can keep track of their investments. So they want to keep an eye on it. So they certainly do not want board meetings happening without them present. A tweak is that if they miss a board meeting and a second board meeting is scheduled to replace that meeting and they miss that board meeting, that's okay. That's their fault. That second board meeting is properly constituted and you can carry on your business. That's one of those negotiation points. So let's get back to the term sheet and the conditions that are in it. Remember what I said at the outset, that a term sheet is non-binding? Well, I kind of lied. There is one term in a term sheet that is binding. And frankly, it's binding on you guys. And that's once you execute and accept the terms of the term sheet, you sign it back to the VC, you have to stop talking to every other VC that you've been engaged with. It's called a no-shop clause. And it gives the VC confidence to start paying for the expenses of actually drafting all of the legal documents. So my advice to you is to be, first of all, when you get a term sheet, get a good lawyer. Make sure that that lawyer understands what current market terms are. What's reasonable to push back on? What's current standard practice? And be careful what you ask for when you're negotiating these term sheets. Because you don't want to leave the after 6 to 9 months of working your butt off to get a VC term sheet. To get a VC term sheet and then leave or give the VC the impression that you're going to be difficult to work with, or that they can't trust you, or that you don't understand the process, it's not a message that you want to send. And the last thing that I want to leave you with is that the guy with the gold makes the rules. So I'm happy to take any questions that you might have. I think there's some microphones.
I've seen you put a lots of rules and restrictions, but usually like when you invest your money, how many percentage of the shares or the company you want to control? control?
That all goes back to the valuation question.
Oh, okay.
How much do I think the company is worth? How much do you think the company is worth? And therefore, how much do you think my $500,000 is worth?
Oh, okay. Thank you.
No problem. You know, surprisingly, I don't have horns, and I don't have a tail or anything like that. I'm actually a pretty good person. Yeah. Oh, he can go and talk to anybody he wants. It's just binding on you. A VC will never sign a non-disclosure agreement with you, and they won't sign anything that precludes them from doing their business. So they're in the business of looking for the best investment opportunities possible. Now, the one thing that you should keep in mind is that in my business, reputation is everything. So if somebody finds out that I did what you're suggesting, I signed a term sheet and then I went running off to the competition, it won't last. My reputation is really important to me, and I hold it very dear. But no, the binding provisions of the term sheet are binding upon the company that's seeking financing.
Usually when you get a company started from university, it's heavily on technology. And in terms of your criteria to decide on giving an investment, technology versus market versus people, what is your profiling or criteria to decide this?
So for the Investment Accelerator Fund?
Yeah.
Yeah, we're an early stage fund. So we look for companies that are technology robust. So there should be something that is patented or patentable in it. And we're fairly early. We do invest pre-revenue. We want to make sure that the technology is validated in some way. We like to see that the companies have interacted with potential customers so that we know that they're building something that somebody wants to buy. But you can go onto our website and see the rest of our criteria. I think Tony can provide you with that detail. Obviously, they want to get out to the patio and the sun.
But Shirley, if they're dealing with angels, do many of these conditions, are the angels going to ask?
You know, what I have actually seen is an increased level in sophistication of angels. So, you know, angels used to go out and do it on a handshake. That's not so much the case anymore. You're actually seeing a lot of the similar, perhaps not as stringent in terms of some of these conditions, but certain angels can be much more actively involved in the company. They actually might want to have weekly meetings with management because they actually believe they're bringing operational expertise to the organization, and they want to make sure that that gets embedded in the DNA of the organization.
Hi, Shirley.
Hi.
I have a question that relates to sort of what the VCs were talking about last week. They were talking about that replacing the founder happens more often with US VCs, like replacing the founder for another CEO, than it does with Canadian VCs. What's your sort of experience with that?
I'd like to say I agree with them. I think we have less propensity to do it. It's not the first thing that we're going to do when we go in. But I think these CEOs and founders do get replaced.
As a follow-up on the angel investor question, I appreciate this is a VC talk, and I was excited to hear you comment about options around pre-revenue. But there are those that would argue that there is no Canadian angel environment. They all act like VCs, and the real angel market's in the US. I wonder if you could comment on that.
I disagree. At the IAF, we actually have done a number of deals, and we're actively involved in working with the angel community here in Toronto. So Waterloo is very active, actually. York Angels and Maple Leaf Angels.
And is your experience then that they'll get in how early?
They've come alongside of us, pre-revenue companies.
Okay. And you would describe your group as being relatively new, or how long have you been established?
We dotted our I's and crossed the T's with the Ontario government, who provides the funding for the Investment Accelerator Fund back in 2007.
Okay.
We've been investing actively for 2 years. We have about, as Tony indicated, just around 30 companies in the portfolio. And I would say many of those actually have co-investments with angels.
Right, and then the OCE template for acceptance and management of funds applies to your group as well?
So you mean like the market readiness at OCE, or?
Any access to funding, I know that goes through a certain set of
Yeah,
criteria.
we have an we at the IAF have a very specific process that we follow. We have to, because we have to be
good governance, of course.
We're government, so it has to be very clear and very crisp. And I can certainly chat with you about the process that we follow.
Sure.
But what we have found is that if the IAF is interested in an investment opportunity, many of the angels end up being interested in the investment opportunity.
Good, thank you.
You're welcome. Yes? Yes. So the question was, when do boards actually get started? And then what's the relationship between the VC and the board? So the answer to the first part of your question, right away. The earlier you can demonstrate to me that you have the corporate rigor that I expect, you're actually taking minutes at board meetings that are held regularly, that you know how to deliver a corporate package, and I can track how all of the decisions that you're making and how you're making them as part of my due diligence, the better, as opposed to saying, oh, I got to make a board right now. So just get into the rigor and the discipline, the corporate discipline, earlier rather than later. The second part of your question is an interesting question, because theoretically, board members are supposed to act in the best interest of all the shareholders or stakeholders of a company. And if you recall what I said, it's that a VC is going to want to have 2 seats on the board and allow you to have 2 seats as a founder and an independent. So the question always comes up, how independent or how independent is that VC representative on the board? Typically, one of the VCs, actually, the VC investor actually sits on the board. So, there is a philosophical debate about, is he really taking into account the interests of all of the shareholders or just himself as a single shareholder? But a good VC does know the line and doesn't cross it, because there is a fiduciary duty legally to act in the best interest of the company.
I'm just wondering about the process. You say that you're looking at startup pre-revenue, okay? You come to the end of the life cycle, 5 to 7 years. You want your money out. What if that company, okay, is making good money? You're expecting it to continue on, on the upswing. Yep. Do you continue with that company, or is it there then
that's where the redemption
handoff?
No, that's where the redemption. So are you talking about the IAF or just in general?
Just in general. So
that's where the redemption clause comes in. So because I, as a venture capitalist, have a fixed life, I can only live for 10 years. And at the end of that 10 years, my investors want their money back any way they can get it, which is reasonable. If they can get it, and well, yes, they want their money back and more, as Tony points out, a lot more, hopefully. So that's where that redemption clause comes in. It says, okay, look, you're a good company and you're doing just fine, but you know what? I still have to get out. So either you buy back my shares or I'm going to force a sale. So you do have the ability to buy the VC out if he executes the redemption. If you don't have the money, which means you're not as good, you're not performing, then he's going to force a sale to get his money out.
Okay, so there's no handoff, like you as a VC then going on to some other VC.
That's not typical. It's not typical, and it's not what you should expect. What you should expect is that the VC does a redemption.
Thank you.
Hi. So VCs, they are ideally looking for 10 to 12 times the return over a period of 5 to 7 years. I do understand how technology-based business plans can give those returns, but could you please quote some examples of non-technology-based business plans which can actually go ahead and give those kind of returns?
Frankly, no. My experience has all been in the technology area. I know that there are colleagues who practice in the life sciences area. My experience is that the VCs who practice in that area understand that industry quite well. They know what the investment horizon is, and they're comfortable with that. So if you're a life sciences company, then make sure you're talking to a life sciences VC or the partner responsible for life sciences at the general fund. Because if you're talking to the wrong person and you're a life sciences company, it's not going to fly.
Right. Well, I do see a lot of non-life sciences and non-technology-based entrepreneurs looking for VC funding, and they do waste a lot of their own man hours in it. So do you think that they should not at all look for the VC funding, or what do you have to say about them?
You know what, there's some smaller, there are funds out there, I know a couple of them, that aren't really looking for technology, and they're not really looking for life sciences, but they're few and far between, and you have to, it all goes down to making sure you're doing the right investigation. So if you remember, I said ask them what their last deal is. That'll tell you what their appetite is. And it's a quick way to discount people. And look at the portfolio companies that they have invested in and have published, because that's what they want you to know about. They want you to know that they're an internet company. They want you to know that they're a mobile space company. So basically, don't come to me unless you're one of those two. Right? So look at their existing portfolio, figure out who they are, what they're interested in investing in, and go from there. And that's the best way to avoid wasting your time.
Right. Thank you.
Okay.
I would just comment, there are some funds, infrastructure funds.
Yes.
That are VC, they tend to go
Much bigger.
much bigger plays, lower risk, so they may take a little lower return per deal just because there's a lot of money in play and it is lower risk.
Right.
But that's a small fraction, and
They're typically not startups
yeah,
either.
and
You know,
yes,
it's just
yes, it's hard to be a startup, a highway builder, and if you're doing retail,
there's one.
At one point when I was in the process of being burned in an investment in a nightlife company, I think we discovered that less than 2% of all VC investments involve classic retail products. So not a lot of people going there.
No.
Angels, maybe. The guys like that had that those airplanes with compressed air rage a few years ago, you get smart angel money in something
Sure.
like that. Toys are a huge risk.
Yeah, absolutely, absolutely. I think there was one more question, but maybe Tony answered that. Oh, she's at the microphone here.
Go ahead. So I was wondering, you mentioned that IF is focused on technology companies with a cap of $500,000.
Yes.
So I was wondering, is that the hard rule, or are you guys actually interested in biotech companies that trying to advance their drug pipeline?
Our criteria is that there's strong IP in the company.
Okay.
So I do have a colleague who is a postdoc out of Harvard, and he handles everything that involves DNA or molecules.
Thank you. I'm sorry.
Your criteria, is it the person or the business plan or the market?
Oh, it's everything. It's the business, the opportunity, the people. Well, remember what I said earlier. Do I actually see myself doing business with this person for the next 5 to 7 years? Do you see yourself doing business with me for the next 5 to 7 years? Because that's how long we're going to be together. So, it's about people. This business, as much as it's about money, it's about people as well. So yes, people factor into it, but I need to see a big market with a growing opportunity, a piece of technology that has a competitive advantage, and all the other criteria are up on our website. You're more than welcome to take a boo at that.
Thanks, Shirley. Amazing information. But since Mars has social innovators,
Yes.
what hope is there for them? Any ideas or any lists of angels or VCs, or what can they hope?
Well, I think the Mars Innovations Group is probably the best place to start for that type of a question. I know angels who are very much into social enterprise. But I find that social innovation side of things, although there is a great push to try to create a social venture fund, it hasn't happened yet. And I would welcome the day when that happened. But myself, most of the people that I know are all motivated by profit.
Okay, so there are no trends that we should be looking for? Like tax,
you know what, Norma, how about
huge tax credits, etc. Coming?
No, go ahead. Tony, you probably know better than I.
What I would say is we deliberately sort of split this into two lectures. The Bill Young lecture was really all about social entrepreneurship and a number of clever ways of creating business models that achieve social ends. Shirley, and I think, I've told you this joke, we're the VC types, we're the anti-social investors. Shirley is talking about the financial, the hardcore business-driven investors, and there's really not a lot of overlap between those two, which is actually why you see quite a different flavor in those two different lectures.
It's very good that you did that then.
Yeah, thank you.
Hi, you made a couple of comments earlier about your willingness to facilitate relationships with beta customers. Could you comment a little bit more about, I guess, the range of attitudes for different investors from different stages and their willingness to kind of be a conduit or a channel to reaching customers, and excuse me, if it reaches a point where they're much more hands-off and they say, we give you some money, build your sales team, go out and do it yourself?
I'll be honest. A lot of VCs say they bring value and they really don't. So that's why it's so important to do your due diligence on the VC. So if they're saying to you, we're going to bring you a lot of value, so that's why we're pushing hard in the valuation. That's where having called all of the CEOs of their portfolio companies and asking them, do they actually bring the value that they say they bring? And you'll be surprised what your CEO colleagues will actually talk to you about. So we actually do bring, in my opinion, some solid value. We're not in on a day-to-day basis. You don't want us to be there on a day-to-day basis. But we're certainly active investors. We attend the board meetings. As an example, one of my earliest investments, I had a weekly call with the CEO. And we said, okay, you said you were going to do this, your say-do factor. You said you were going to do this week. Did you actually do that? What do you need? And I would always end the conversation with, what do you need from me this week? And if I could, I'd let her know I could help. And if I couldn't, then I wouldn't. But at least she knew. And in my mind, that was a great working relationship. And as the company matured, we stopped having the weekly calls. We had monthly calls. And the monthly calls progressed the same way. You said you were going to do this. Did you do it? What do you need from me this month? So it all goes back to you investigating and making sure that the VCs you're getting in business with are the ones you want to be in business with.
Okay, thank you.
You're welcome.
Is that a top 2 company, a bottom 2 company, or a 6 in the middle company?
At the time, I didn't know which one it was going to be. It was too early. It's turning out to be one of the top 2.
Hi, I was just wondering how likely a VC is to allow their money to go overseas. Say if your company wants to develop a drug in China, say, is the VC going to be very objectionary to that?
So will the VC be able to help you to find a partner in China?
Well, exactly. Or say, well, it might be cheaper or faster to develop a drug in China, say.
I think they'll be able to help you figure out whether it's going to be cheaper, faster, or in my case, do you really want to put the intellectual property at risk? There are some funds, very large funds, who have the networks, global networks. I think DFJ would be an example of one of the funds that have the global networks that they can actually say, okay, DFJ China, one of our companies in Toronto, actually needs help. Not many VCs have that network. And they don't have that network because most of the time they want to invest in things that are within a certain radius of where they exist. They want to be, an hour, maybe 2 on a plane ride, maybe an hour drive. So Toronto invests in Waterloo.
So places where they can get to the CEO faster.
Where they can get to easier. Okay. So that if there is a problem, they can get there and fix it. Okay. Right? If there's an emergency board meeting that has to happen, they can be there.
I just had a question about legal expenses when you're negotiating a deal. I mean, in your opinion, for $500,000, what would be a reasonable or average legal expense? Because generally you get a term sheet saying, well, here's the money that we're going to give, but this much legal expense will be paid out the money that we're giving. So, what's the average or reasonable, let's say, in your opinion or experience?
Can I answer that question? So, I always start as a VC. I always start my term sheet saying, the company will pay my legal expenses, whatever they happen to be, because you're asking for the money. And there's somebody out there that's willing to pay my legal expenses. I'll be honest, I have capped it. Depending on how I feel a deal is going, I've capped it at 5. I've also capped it at 10,000. But I am reluctant to do that because I want to make sure that you, as a founder, manage your lawyer effectively. And I got to tell you, there's no better way to make sure that you manage your lawyer effectively than to know that you're paying your bill and you're paying my bill as well. So it kind of does away with all the superfluous negotiations about legalese and forces everybody to focus on what the true business issues are and the proper allocation of risk between the company and the investor.
Just to follow up, like what's in your experience has been the average? Let's say, you have done a lot of deals, so what has been the average? I need just a yardstick to,
A yardstick? As low as 5 and as high as 25. That was a bad deal, by the way, the 25.
So would you join me in thanking Shirley?
Sure.